As of this moment, Rezolve AI PLC, trading under the ticker RZLV, is priced at $4.85, marking a sharp intraday drop of over 7.3%. This immediate, aggressive downside move tells a story that goes far beyond simple market fluctuations. Just days ago, the company announced the closing of a massive $200 million financing round from some of the biggest names in the investment world, including Citadel and BlackRock. The common expectation, the narrative most would subscribe to, is that such a monumental infusion of capital from sophisticated institutional players should act as a bedrock for the stock, signaling unshakable confidence and providing a clear runway for growth. It should, by all conventional logic, stabilize the price and launch it into a new upward trajectory. Yet the reality we are witnessing on the screen is the complete opposite. The stock is volatile, reactive, and currently under significant pressure. This isn't just a simple case of market jitters, it's a glaring contradiction that forces us to look past the headline-grabbing funding announcements and question what the market is truly pricing in. Is this a momentary dip, a buying opportunity created by nervous retail investors, or is it a sign of a much deeper issue that even $200 million in fresh capital cannot immediately resolve? The prevailing belief surrounding Rezolve AI is one of immense untapped potential. It operates in the white-hot intersection of artificial intelligence and e-commerce, a sector that promises to reshape the multi-trillion-dollar global retail market. With strategic partnerships touted with tech titans like Microsoft and Google, the company presents itself as a key player in building the future of digital commerce. The expectation is that Rezolve AI, with its proprietary Brain Suite platform, is on the cusp of exponential growth, making the current growing pains mere growing pains. However, when we challenge this narrative and scrutinize the underlying fundamentals, a far more complex and precarious picture emerges. The reality is that this is a company with staggering negative shareholder equity, last reported at over negative $37 million. Its revenue is, to put it mildly, negligible, standing at just over $187,000 in the last fiscal year, while its net losses ballooned to a colossal $172 million. This creates an almost surreal valuation, with a price-to-sales ratio that stretches into the thousands. The recent financing, while impressive, was not just about fueling growth. It was an act of survival, a necessary measure to shore up a balance sheet that was deeply in the red. This is the central tension, a futuristic, high-growth narrative clashing violently with a financial reality that suggests a business burning through cash at an alarming rate with very little to show for it in terms of actual sales. This conflict is further inflamed by the recent emergence of a short seller report from FuzzyPanda Research, which the company has vehemently rejected as misleading. This has turned the stock into a battleground between those who believe in the long-term vision and those who see a fundamentally flawed business model masked by AI hype. Analyzing the stock's recent movement reveals a theater of extreme volatility. Today's trading session has seen the stock trade in a range from a high of $5.45 down to a low of $4.83, a significant spread that speaks to the uncertainty gripping investors. The trading volume is immense, already exceeding 16 million shares, which is well above its 90-day average. This high volume on a down day suggests strong conviction among the sellers. This isn't passive drifting, it's active, aggressive move. Looking back, this is not an anomaly. The stock's 52-week range, stretching from a low of $1.07 to a high of $9.45, paints a portrait of a classic high-risk, high-reward speculative asset. The recent institutional activity is, of course, the elephant in the room. Securing $200 million is a major achievement that cannot be understated. It provides the company with significant operational runway. However, it's crucial to understand the context of such placements. Often, these deals come with terms that can lead to future shareholder dilution. In fact, records show that shareholders have already been substantially diluted over the past year, with a 44% increase in the number of shares outstanding. This is a critical point for anyone considering an investment. While new capital is positive, the cost of that capital, paid for by the dilution of existing owners, must be factored in. Furthermore, the timing is critical, with the company's next earnings report slated for tomorrow, October 1st. This will be a moment of truth, where the company will have to demonstrate tangible progress and provide a clear outlook that can justify its market capitalization in the face of its financial performance. The consensus analyst estimate for earnings per share is a loss of 3 cents, but the market will be looking for much more than just hitting a number. It will be looking for a credible path to profitability. So what does Rezolve AI actually do? The company's core offering is its AI-powered mobile commerce and engagement platform, the Brain Suite. It is designed to help retailers, brands, and manufacturers connect with consumers more effectively. Their technology enables features like visual search, where a user can point their phone's camera at an object and instantly find similar items in a retailer's inventory, and streamlined checkout processes. A key part of their marketing is the claim that their proprietary large language model, BrainPower, achieves zero hallucinations, meaning it provides reliable and accurate outputs, a critical factor for enterprise adoption. Their business model is multifaceted, relying on a combination of subscription fees for access to their platform, transaction fees on purchases made through their systems, and strategic partnerships. They've highlighted a multi-year deal with the major department store chain Liverpool, valued at nearly $10 million annually, as proof of their commercial traction. However, this single data point, while positive, is not enough to offset the broader financial picture. The company's history is that of a pre-revenue or at best very early-stage revenue entity that has spent heavily on research, development, and marketing to build out its platform. This is a common strategy in the tech world: spend now to capture market share and reap the profits later. The question for investors in Rezolve AI is whether the later will ever come and if the platform is truly as differentiated and valuable as the company claims. Without a dramatic and rapid acceleration in revenue, the current business model is simply unsustainable. Looking toward the future, we are presented with two dramatically divergent scenarios, a perfect illustration of the expectation versus reality framework. The bullish expectation is that Rezolve AI is at an inflection point. Armed with a fresh $200 million, the company can now aggressively expand its sales and marketing operations both in the US and internationally. Management has projected that the company will reach over $100 million in annual recurring revenue this year, a figure that, if achieved, would completely alter the investment thesis and likely send the stock soaring. The partnerships with Microsoft and Google could begin to bear significant fruit, driving enterprise adoption. Their collaboration with Tether to integrate a new US-compliant stablecoin could position them at the forefront of next-generation payment systems. Wall Street analysts, for the most part, are buying into this narrative, with a consensus buy rating and an average price target suggesting significant upside from the current price. This is the vision of a company successfully navigating its initial cash burn phase to emerge as a dominant force in AI-driven commerce. The reality, however, forces a more sober assessment. The risks are substantial and cannot be ignored. The forecast to remain unprofitable for the next 3 years is a major concern in a market that is increasingly demanding a clear path to profitability. The company's ability to reach its ambitious $100 million ARR target is far from guaranteed and should be viewed with a healthy dose of skepticism until tangible evidence emerges. The extreme stock volatility makes it unsuitable for risk-averse investors, and the specter of further dilution will likely remain as the company continues to fund its operations. The presence of a vocal short seller actively betting against the company adds another layer of risk, as these campaigns can exert significant downward pressure on the stock price regardless of the company's long-term potential. Rezolve AI is either on the brink of a massive breakthrough or a spectacular collapse. Comment below with bull or bear and tell me which side you're on and why. This is a critical juncture, and the outcome is far from certain. You have firms like Fidelity, who may hold such stocks in their Fidelity ETFs or Fidelity mutual funds, and platforms like Robinhood or SoFi Invest, where retail traders might be speculating on its future. Even sophisticated traders using interactive brokers are likely watching this name with keen interest, trying to decipher the conflicting signals. In conclusion, the story of Rezolve AI is a masterclass in the tension between a compelling market narrative and a challenging financial reality. The expectation, fueled by the allure of artificial intelligence, big-name partnerships, and massive institutional funding, is that of a future industry leader. It's a story that is easy to believe in, a vision of frictionless commerce and exponential growth. The reality, however, is found in the stark numbers of the company's financial statements: minimal revenue, profound losses, negative equity, and a history of shareholder dilution. The recent $200 million capital injection is not merely a tool for expansion, it is a critical lifeline. The market's sharp negative reaction today, in the face of such positive funding news, suggests that investors are beginning to weigh the harsh reality more heavily than the optimistic expectation. The upcoming earnings report will be a pivotal moment. It will either substantiate the growth narrative and begin to align reality with expectation, or it will reinforce the concerns of the bears, confirming that even the smartest capital in the world can't change a fundamentally flawed equation. The battle for Rezolve AI's future is being fought right now, and the outcome remains deeply uncertain.